Glad to see we have some people joining us.
Yes, it is 11 o'clock. So welcome everyone. There's still people rolling in and that's just fine. Thank you everybody for joining. My name is Claire Davis. I'm the marketing manager for Johnson Consulting Group. Today we have Bob Ekins of JCG and Tim Bridgers of Live Oak Bank, and they're going to get talking about the opportunities for growth and expansion. Just a quick housekeeping announcement. Questions, you can funnel those in throughout the entire webinar. We do have time at the end for questions as well. But if anything pops up in your brains, go ahead and just type it in the message panel to the right of your screen, and we will make sure Bob can facilitate some of those questions. But if he forgets, I will facilitate them as well. But without further ado, I'm going to kick it off to Bob to intro.
Well, thank you, Claire, and welcome everyone to today's webinar with Johnson Consulting Group and Live Oak Bank. I'm very excited to visit with everyone today, especially Tim Bridgers, who leads up the lending for funeral and cemetery channel vertical at Live Oak Bank. Tim and I will have a discussion. He's got some slides to share with us. We obviously welcome all questions and chats along the way. We'll have time at the end for some questions as well, but I appreciate everybody joining us, spending a little time with us today. It's a very important discussion around opportunities in the funeral space and what's going on in the market. So with that, Tim, I appreciate you joining us and leading this discussion today.
Thank you, Bob, and really appreciate the opportunity to speak alongside with you and share some valuable information, and also look forward to hearing your input as we talk about opportunities for growth and expansion. We all know that the economy has changed drastically over the past 2 to 3 years. So credit boxes are changing constantly. Rates are changing. Credit requirements for capital is changing. So there's a lot of things to consider. And I think we should never assume that we can't achieve financing for that next project. So today's effort is to not only talk about how to really prepare for that, but what's available to you and how you can be successful in that effort. And so a little bit about the bank, which we're not going to really dive into too much, but just to let you know that we are a real FDIC insured bank nationally. And you're not going to see branches. And that's because we're an online bank, money market, CDs, savings, and those things. And soon to be a next generation checking and savings for small business. This is a little snapshot of kind of, if you ever came to our office in Wilmington, North Carolina, this is what you'd see. We're approaching 1,000 employees and really get excited to help small businesses really thrive. And Bob, I think it'd be appropriate if you shared maybe a little bit about Johnson, kind of what you guys do, and for those on the call that may be new to Johnson Consulting.
Yeah, thanks, Tim. Yeah, Johnson Consulting Group obviously is focused in the funeral and cemetery profession as consultants helping small business owners maximize the value of their business during the business life cycle, which really means even if you're not even close to selling your business, we want to work with you to help you get everything hitting on all cylinders in order to maximize that value when it's time for your succession planning and exit plan from ownership. So obviously some of that is what we're talking about here today, looking for growth opportunities. That could be in-market acquisitions or strategic acquisitions to expand your marketplace. In addition, we do a lot of back office work with our clients to make sure that their finances are in order so that when these opportunities come available, they can get the lending that they need or do the expansions that they need to their business. So all around, Johnson Consulting started officially back in 2000. Tom Johnson and now his son Jake Johnson own and operate the company, and they have touched a lot of funeral home owners across the country and in Canada over those last 20 plus years. So
Thank you, Bob. Yeah, I think you said something there that really rings a bell about the thrust of this material today. And I think whether you are on the call and you're interested in owning if you're on the call and you currently operate or manage and you want to grow and expand, or if you've been doing that for 30 to 40 years, I think all this material is going to be applicable for you today. And you mentioned the phrase in order. And I think that what we really want to help you walk away from this material today, understanding, is how to really get your business plan, your financials in order, and your understanding in order to be able to achieve a successful transaction. And that's the biggest hurdle. The opportunities are out there, trust me. If you're looking to acquire, it's more about being in a position to accomplish that goal. So I want to first begin by laying the framework and the groundwork for how to get in order. And if you're operating a business today and you're looking for the next step, or if you're getting ready to purchase your first business, you have to understand EBITDA. You have to understand the operating cash flow of the business to, one, determine if what you're looking at purchasing is going to be a healthy purchase or not. And then you're going to have healthy conversations with people like Bob at Johnson. You're going to be able to have healthy conversations with the bank. And that's going to build confidence with all parties that you are prepared and ready. So we're going to lay some groundwork real quick on this. And if you have questions throughout this, we highly encourage you to post those questions in the chat. Me and Bob will be keeping a close eye on that. And if we don't address them during the material, we'll try to address those at the end. So please share your questions. So let's start with talking about EBITDA. And Bob, please interject here if you see something you want to add and contribute to. But in its basic form, EBITDA is defined as your earnings before your non-cash expenses, like interest, taxes, depreciation, and amortization. We all know that for tax purposes, we want to deduct as much from our net income as possible. When we do that, we have less tax liability. So your accountant is going to help you do that. And fortunately, we get to deduct our interest expense, depreciation and amortization, and reduce our net income. That way we pay less taxes. But when you're looking at the actual cash flow of the business, you actually want to add those things back in, because that's real cash that you actually have available to you during the year to pay things like marketing strategies, to cover salaries, your own and your employees. So it's very important. So EBITDA is just that. It's your net income that you use for tax purposes, and we add back those non-cash expenses. We're going to go piece by piece here and start with earnings, and we're going to just review these 4 quadrants, and then we're going to move on from this. And if you have questions, please make note of those. But when we talk about earnings, that's really the goal of us here, is to grow earnings, increase earnings. We're trying to increase earnings, and we're trying to decrease expense in its simplistic form, right? So without earnings, we really have nothing to talk about. We don't have EBITDA, okay? So when we're looking at revenue, obviously we want to maximize revenue. We're going to get into a little bit of that today, and how to understand revenue trends and what it means for the business. We're going to back out of that your cost of goods sold. We're going to back out the wages. We're going to back out the other expenses for the business. And obviously we're going to back out income taxes, and then that's going to be your earnings, your net income. Okay. Again, the strategy there in its simplistic form is to make that number at the end of the year as large as possible. And you know, to really position your business to have the most cash flow available to help acquire the next business, or to be ready to launch a new marketing plan or a business strategy. You know, interest, right? Understanding EBITDA is really important. Now, if you're looking at a target business to purchase, interest is really important to understand, because that business owner's appetite for debt could be a lot different than yours, right? So by adding that back, we're leveling the playing field, so you can compare that funeral home that you want to purchase to other funeral homes across the country. So by adding that back, you're taking out that element of that manager or owner's discretion around debt, okay? So not only are we adding it back because it's a tax deduction, we're also adding it back to that target funeral home, so we can really compare to other businesses. Same thing with taxes. If you're looking at acquiring a funeral home and you believe that you can better manage the tax implications, then you would want to add back their tax liability for the year. Okay, if we're looking at 2021, you would add back the tax liability for the year, again, to normalize that business compared to all businesses. And then you would take back out a tax that you believe is going to be realistic. Bob, we've seen this from your team quite a bit, right? To where if you're analyzing a business that's for sale, it's not uncommon for you guys to make an adjustment for taxes because you think it's pretty high, knowing that a new owner could come in and probably reduce that tax liability. Do you have any other input there?
Well, I do, and you're right on both the interest, the taxes, and also the depreciation amortization. I refer to, when we do this, to value a business, we're looking at what I would refer to as an adjusted EBITDA. And that's what we like to consider, is if that business was in an absentee ownership scenario where the owner wasn't living in that community and running everything, that personal expenses and vacations and everything through those numbers, through their books, what would that business look like if it was really run strictly as a business to generate as much earnings as possible? And that's what we try to get to, is that baseline Tim's referring to. Both that's for the buyer's benefit and the seller's benefit, to know what they're actually purchasing. The buyers when they're purchasing, and the sellers when they're trying to maximize the value, is to get to that fair adjusted EBITDA number, and then they can do their math from there.
That's right. Yeah. So getting to that baseline is so important. And then you can make the adjustments per how you're going to manage the business and really see what the result of that is. And we're going to look at an example of that here in a few. And then last but not least, we make that adjustment for depreciation and amortization, because again, you may manage that as slightly different. So you want to really get a picture of what that looks like prior to that deduction. Okay. So again, that's what EBITDA is. So when you hear about multiples of EBITDA, which is a very common phrase around the profession, especially right now related to all the movement and transactions that are going on, before you can really calculate a multiple of EBITDA to estimate what you may have to pay for this business, you've got to first calculate it, right? You got to calculate EBITDA. So what we've just defined is really how to get to your baseline. And as Bob said, you may not have all the information for a target business to make a full adjustment as an adjusted EBITDA. And that's where, folks like Bob and his team can help you do that and get you prepared for that and get access to that information. It's really, really crucial. So why is EBITDA important? If you're operating a business today, EBITDA is really important for you. If you're looking at buying, an understanding of EBITDA is really important for you. Okay. Why is EBITDA important if you're an existing owner looking to grow and you're looking to use financing? Well, how well you have managed your EBITDA or your cash flow is a sign of how well you will manage another EBITDA or another cash flow in another business. But it also, keeping tabs on your EBITDA trends over time will help you have your company in an optimal position at all times for all things. Okay, so if you're noticing that your EBITDA figures are declining year to year, but yet your call volume is increasing, it means you're losing efficiency somewhere, and you need to pay close attention to that. And we'll dive into this in a bit, but the last thing that a bank wants to see, and probably the last thing that Bob wants to see if he's trying to sell a business for someone, is a declining margin or EBITDA figure while call volume is staying constant. All right, that's a sign that cremation is making an impact on the business, or the owner is maybe not paying close enough attention to the expense structure, and that can be a poor outlook to the business. So if you're looking to buy, you want to look out for that, because it may be a negotiating point for you. Or if you see a business that is actually growing in EBITDA, that's a sign of a really strong business. So Bob, do you have any comments there?
The only thing I would add is, especially in what we're all experiencing here over the last 6 to 12 months with the inflation, I mean, we really have to be cautious of our expenses, because I hate to say it, but those expenses are just dropping right to the bottom line. And it's not uncommon for funeral home businesses to be less profitable right now than they were 12 months ago.
Yeah, that's a really good point. I get pretty fired up about expenses, only because I really believe that, I know that it's really, really challenging for any business and any company, to, no matter the size, whether you're a 5-person employee type company, or whether you have 100 employees, it's really difficult to determine your expense to provide the different types of services you have, because there's a lot of services you have that overlap. So as Bob mentioned, you really need to become a student of your expenses and really truly try to define the cost of providing your services, so you can price accordingly. It is absolutely crucial. So what are some things that impact EBITDA? What are some things that you can do if you are preparing to seek financing or grow? What are some things for your own business that you can do to put you in the driver's seat, right? To be able to call the shots with a bank, with a buyer or a seller? Well, consistent accounting is one. As a bank, we see this, and it makes it very difficult for us to make a judgment call on a business that you're trying to purchase or your own business if you've had multiple accountants over a short period of time with different accounting methods and strategies. So I would highly encourage industry-specific accounting. Obviously, that comes with accuracy. A lot of times we see a lack of accuracy with a lack of knowledge of the profession. And of course, transparency. In order for us to be able to make adjustments to your cash flow and understand the true cash flow available, we got to know everything. We got to understand if you do have personal expenses running through the business, just understand that that's okay. That's your choice. We don't recommend it, but it's your choice. But what it does is it actually helps us to see the true cash that's running through the business and what's available. So transparency. And then, of course, the management. If you're not talking with your accountant as a business owner and understanding where you are and why you are where you are, you're going to have a tough time talking with the bank about what you need and why you need it. So I would highly encourage you to have at least quarterly or biannual conversations with your accountant to understand kind of the trends and what they're seeing in your business. And Bob, I know you guys do accounting for folks. If I'm not mistaken there, what's probably some of the biggest challenges you see from that perspective in your experience?
Well, yeah, so we obviously work with clients that use our industry specific services, but then we also work with clients that have really solid accounting firms working with them. And then as you mentioned, that are kind of all over the board. So the more your accountant CPA is knowledgeable on our profession and what is important for owners and to value the business, that's very important. I mean, the easiest example is cash advances. When they don't really know how that plays into the whole scheme of the business, that's an important piece to educate them on. But yeah, you definitely don't want to be jumping from one accountant to the other, especially as it gets later in the valuation process of the business for succession planning purposes.
Yeah, you want to make it really easy for the bank to make those adjustments to your earnings, right? We want to be able to identify interest expense easily. We want to identify the unusual add backs very easily. If we have to go digging too far, it gets really difficult. So again, it's so important. It's almost the foundation of your EBITDA figure. And then, of course, we talked early on, we talked about earnings, right? We talked about without revenue, you don't have earnings. So you really need to be a student of your revenue and a student of your desired location's revenue. So if you're looking at a location to purchase, you not only need to understand your revenue trends and the why behind it and what you've done to mitigate challenges or opportunities, but you really need to understand your target as best as you can. It's one of the first things that I look at as a banker. I look at revenue trend versus call volume to kind of get a gauge of cremation impacts, how well you're managing the cremation, how well you're maximizing the value of your cremation service. I'm looking at cash advances and I'm looking at the story. How well do you understand your own revenue trends? If you understand your own revenue trends, you're likely going to understand what you need to do to the target to help it be as successful as your existing business or what needs to be done. Not every bank is going to be interested in that, but they should be, because it's a crucial element of your success. And I think it's something that you really should pay close attention to. Just two more items as we talk about accounting, and we'll leave accounting. Accounting can be kind of a dry subject. I know for me, in-depth accounting is, it can be mind-numbing sometimes, but it really is important to be aware at least of the terminology and the impacts. COGS is one of those mind-numbing topics. They often get overlooked because it's boring, right? It's the products you need to provide the services you provide. And sometimes it's the cost of services that you pay, whether it's part-time help, depending on how your accountant structures that. But look, this is a big deal in the business, okay? One, if you are not charging the right price for your services, then you may be losing money because you are having to pay someone else for those products, right? And so what you're paying for those products, the embalming fluids and all the other tools that you need to provide your services, or what you're paying part-time help, part-time labor, all that matters, because if you're not appropriately charging and adapting to the increase in those costs, then your margins are shrinking, that EBITDA number is falling off. And you could have increased revenue and still show a decline in EBITDA by not managing your cost of goods sold. So my main point here is just be aware of what you are paying for your goods and services over time, and you should be making appropriate adjustments to your pricing according to those trends. Okay, we all know in the past 24 months that if we looked at a graph of the cost of your goods, it was pretty erratic. Okay, well, your pricing should somewhat follow that. Your pricing is probably going to be more in a bell curve because you don't want to be too erratic with pricing. But if you look at your pricing curve compared to your cost curve, they should follow a similar trend. And so very, very important. So important. In fact, Bob, do you have any thoughts on, you talked about expenses, right? I mean, is
Yeah,
this
Tim,
something
we
you
have,
feel that-
when we value or analyze any business, we are going with our industry benchmarks. So over the years, we've obviously been reviewing a lot of funeral operations across the country, and we continue to keep that data and adjust our benchmarks. And just for example, cost of goods sold is we like the range of 13 to 18% of your net revenue being without cash advances. So you'll want to make sure you pay attention to that one. And there's obviously some other benchmarks that we have as well, but and we can get those to you after this presentation if you'd like to see that, those targets that we have in mind for well-run businesses.
Yeah, and Bob, you hit on something there that I want to highlight. And Bob is talking about a margin that you can measure to, right? It's your cost of goods sold divided by your revenue, and that's your cost of goods sold margin. And with Bob's data, you can compare your business or a target business to that data to see if it's off. But what's interesting is you can do the same thing with your EBITDA number. You can take your EBITDA number divided by revenue, and you have an EBITDA figure. And you can compare numbers to that as well. And you can also do that with what we're going to talk about next, and that's wages. You could take your total wage expense divided by your revenue and get a percentage and compare the health of yours to others. And I'm sure, Bob, you have a margin on that too, right? You said 13 to 18% for COGS. What's your benchmark on wages?
Yeah, so we have wages we consider personnel expenses. So it's everything that's related to your staff. And we are currently in the 30 to 35 range, 35% of net revenue for that figure. And obviously, as we all know, what's going on across the profession and in the world with staffing, that's obviously going to have to be very closely watched as we go forward. That's going to take, it's already the largest bucket in our financials. It's likely going to be a bigger piece of the pie here as we go forward.
Imagine what happens, right? If you're struggling to get that additional call with your competitors, imagine what happens if you're able to negotiate a lower price for your goods. You're able to increase prices appropriately, and you're able to streamline your wage expense to make it better and more efficient for your business. Those three things alone, without getting one more call, is drastically improving your EBITDA or your earnings. Very, very important, and something that I would highly encourage you to talk with your accountant about. They would certainly have some insight. And then we talk about non-cash expenses. We already talked about that. There's no need to dive into that. That's all the elements of EBITDA that we already went over. But this is important, right? Pro forma. So, we said several times that in the EBITDA, there's also adjustments. So after you add back interest, taxes, depreciation, amortization, you're then going to look for those adjustments. If you were looking to buy a business, the owner's salary is going to go away. So you're going to add that back. That is now available to you as a new owner. And whether you take a salary and readjust it or not is determined, depending on the situation, we make that adjustment. There may be some employees that are going to go away. You would make that adjustment. Maybe the business last year replaced the AC unit or a roof, and we consider that a one-time expense. Those are things you're going to want to know so we can make an adjustment for that year. And then the other one-time type expenses. And why is that important? Well, if you're looking to buy a business, we need to know those things about your business so we can see your true cash flow and give you credit for that. Your cash flow could be the difference in paying this price versus this price. If you have a stronger cash flow, you're going to support a stronger purchase. You also need to understand this about your target. If the bank cannot justify lending a certain amount to the business you want to purchase, okay, sometimes identifying these add backs is the difference. And Bob, we probably spend most of our time together on deals with this. It's understanding the add backs. It's validating them. Probably one of the bigger challenges, I would say, in the transactions. What are your thoughts on that?
Yes, the add backs is definitely where it's going to always get held up in the financing if there's not good notes and records of what those all are. So to me, that's the most important, is keeping solid records. It's okay, as we talked earlier, we're not the IRS looking to ding you for what you've taken out from your business. But when it comes time for this transaction or buying something, you need to make sure that we have all the ducks in a row and have those documented so that the bank can feel comfortable that that business really does that much. Another one that's interesting is the cash. I mean, some funerals are still paid with cash, and owners make the business decision whether to record that or not. And at times that come back to bite them when it's the opportunity to maximize the value of their business when they're selling it, is because those are hard to justify and hard to prove that that's going to come through every year for the new owner. And then I think one on this pro forma piece, Tim, just to make sure all the audience understands, just because we remove the owner's salary, we typically, that owner is going to have to be replaced with either another owner's salary or a general manager or another funeral director. So we need to make sure we have staffing in our personnel bucket. We need to make sure that is all accurate.
Absolutely. And that's one thing as a bank we take very serious. We want to make sure that you're positioned to be able to pay the appropriate staff you need to operate the business or yourself. And that's very important. What we typically do is we'll look at, as a buyer, we'll look at your personal credit obligations, and we'll multiply that times 2 as a starting point, just to make sure that the business can support your need and lifestyle. So, a quick quote by Chris Mercer, in talking about the transaction, the goal is to have as much EBITDA and the highest multiple of EBITDA available in the marketplace at that time that the businesses offer for sale. So whether you're here today and you're operating and you're thinking about growth, that's great. But if you are managing your business to always at least know and understand where your EBITDA is, why it is where it is, and what your goal for it is, not only are you going to be in a position to grow and get access to good, cheap capital or the cheapest capital, you're also going to be in a position one day to sell and be really successful with what you earn for the business.
Well, I'd like to jump in, Tim, and just because the chatter around the profession lately is the very high multiples that are being paid right now for businesses. As a potential buyer, don't let that scare you off. There have been some deals that do get really large multiples, but that is not for everybody. It's all depends on location, the size of the business, and who the buyers are looking to purchase that. There are still a lot of great deals out there that are at what I would say standard fair multiples that the typical buyer can definitely win to add to their enterprise. So don't let the chatter going on out there deter you from expansion and growth through acquisitions.
Absolutely. Yeah, we have found it. There's been a trend to where most transactions that we see that need financing, we're dealing with what I would consider to be an above average multiple. As long as that business can support that, that's okay. That's then a decision that a buyer has to make and a seller has to make. But to plan your retirement on the assumption that you're going to get the multiple that you're hearing in the marketplace is a very unsafe retirement planning habit and approach. Manage your business to have the most effective growing margin as an EBITDA over time, and you're probably not going to have to worry about achieving your retirement goal. So, and as Bob said, our next slide was talking about multiples of EBITDA and all the impacts to that. So not only does not only does the actual financials impact the multiples of EBITDA, but again, how you've managed cremation rates and how that's impacting your revenue trends impacts the impression of EBITDA multiple strength. If your buyers need debt, or if you need debt to purchase a business, right? Interest rates matter, right? We've seen in the past year, the interest rates were an all-time low, and that was supporting higher multiples. Well, as interest rates climb aggressively from someone who needs financing, that multiple gets stressed a little bit. So understanding the economy and the market is really important. And then last, I'll say equity is important, okay? If you're preparing for financing, and here in just a few minutes, we're actually going to talk about some products that are available to you. To dive in, we're going to speed up just a hair so we can get to that. It's always good to plan on putting in 10% of the transaction for financing. And some products require more, some require less, but planning for 10% of a desired acquisition is a really good starting point for a transaction. So a couple things, and I'm going to kind of go through this very quickly because I do want to get to the different options for financing and then open it up to any questions. I don't think we have any in the chat so far. It's kind of the financial preparedness, right? Whether, this is really important. Having an idea of what you are going to do in the business you're looking to purchase. Okay. I know that sometimes these opportunities pop up really fast, but just take an evening and sit down, think about the market, think about what you know about the business. What have you done that's worked well? It doesn't have to be a 25-page business plan. It can be a 2-page bullet point business plan of how you feel that you're going to attack that market. I can tell you as a bank, we love that. We love to see the eye of the tiger. We love to see a plan in place. Understand as much as you can about the target's revenue and earnings forecast. Why is it done what it's done, and how are you going to change it? Understand the one-time expenses. Obviously, if you're working with Bob and his team in buying a business they're selling or preparing to buy one, they're going to help you with this, but identifying the one-time expenses so you can come to a true cash flow number is absolutely crucial. And oftentimes that is the difference between being able to finance the acquisition or not, and to pay the seller what they're wanting. Business and personal and business expenses, we talked about that. The more you mingle personal expenses in the business, the more difficult it's going to be for you to separate that and for the bank to distinguish that for a new buyer or for you. And then I want to hit on personal financial statement really quick. As individuals, I will tell you that personal financial statements is something that's easily overlooked. Okay. Don't just look at your net worth, but actually look at your total liabilities. And you look at it and you think about what that says about you in terms of your spending habits, character, those things. What you think of that is probably what the bank is going to think of that. Okay. We look at a personal financial statement as a proxy for an individual's spending habits and financial habits going into ownership of a business or growing their business. So not only does your business define how you operate, but your personal financial statement defines a lot of your character traits related to financial decision-making. And that's really, really important. And the same goes for your personal credit. That's really what personal credit is. It's a character gauge that tells a bank, is this person going to pay their debt, or are they going to run from it? Do they have the ability to say no and control their spending? Bob, do you have any comments there on the personal side?
Not necessarily on the personal side, but I think being prepared, obviously, as you mentioned, because these opportunities show up, and making sure you have this in mind, and it's not something you have to do at the 11th hour just to get to the game, is very important to have this piece in place and clean as possible for you. So to Tim's personal comment, yeah, obviously the more you can pay down debt personally or in your business, the better you are positioned to buy the next thing that you're looking to acquire.
Absolutely. And as we round out here, I'm going to show you an example And this is a high level example. And this is one of many, but the point of this is to show the impact of healthy EBITDA management, and really what this could look like with financing. And this is an SBA example. Many of you have heard of, the Small Business Administration 7A financing product. And that's really, really good for a first-time buyer. It's also good for a buyer who is already owning a business and looking to buy their second or third. It really helps them to purchase a business with more minimal equity. And then, of course, we have the conventional products that we're going to hit on right after this example to finish up. But in this example, this business, the business without the real estate is worth around $400,000, or that's what they're asking for. The real estate's worth $1.1 million. And so for that, they're asking for $1.5 million for the business. The buyer profile here has been a licensed funeral director for 8 years, and has been working for the business, it's pretty common. And they're buying 2 rooftops for the 1.5 with a total call volume of 130 calls, which tells me that one of those 2 locations is probably more of a satellite location. And then your average service revenue is $6,500. And then they have a 50% cremation rate. Now, as a banker, what do I say to that? Well, based on what I see, $6,500 is not too bad for a business that's 50% cremation. But there may be some room to improve that revenue per call for a new buyer. And I want to hear the buyer's opinion on that. What are their plans? What do they think about being able to increase the revenue per call? And how are they going to maximize 2 rooftops for 130 calls, which seems a little low for 2 rooftops, depending on where they are. So I'm interested in the plan, right? So let's look at the characteristics of that business real quick. So the revenue of that business is $850,000. The net income, which we talked about earlier, is negative $23,000. Now, this is interesting. You might first say, well, that's bad. Not necessarily. Like I told you before, net income is a tax strategy, right? There's a lot of things that's been deducted from that to show a low or negative income to avoid tax liability. Okay, now, do we want net income to be positive? I would rather it be positive, which means I have a lot of income to deal with. Okay, but that's the scenario here. Interestingly enough, there's $250,000 of add backs. Okay, those are all the things that we talked about earlier: interest, depreciation, amortization, other add backs, one-time expenses that are going to go away, an employee that's going to go away. All right, so $250,000. And so what does that result in? Well, when we make the adjustment, now we have an EBITDA. I'm calling it NOI here. EBITDA for you listening, $227,000 of EBITDA, or $227,000 of cash flow to support your future loan. All right. As I told you, and as Bob mentioned, you can take that number, divide it by the revenue, and get a margin. And so in this situation, the EBITDA margin or net operating margin is 26%. Okay. Now, the way I look at that as a banker, I say 26% is not horrible, but I know from what I see that 26% can be better. I could easily be 30 to 35%, depending on pricing, of what you're paying for your expenses, how you approach the market. So I would say there's an opportunity to improve this business. Well, let's see the outcome. Okay. We further judge the business. I mentioned to you how important COGS are. So let's look at COGS of the business. The cost of goods sold was $223,000 for the prior year, divided by the revenue. So your COGS here is 26%. Based on what Bob told us, I would say that that's pretty high. Which means to me that either pricing can be adjusted, or maybe they're paying too much for their goods and services, depending on where they are. There can be an improvement in the expense control of the business. And then we drop down to wages. Okay, 22%. Now, assuming they're putting all of the wage-related expenses in there, I'd say 22% is pretty good, especially with inflation. So not too bad. Some room for improvement, nothing too alarming. So now let's look at the payment, and then we're going to look to see if this is realistic or not. And you're going to see why EBITDA is really important for the business that we're buying. Again, we're buying this for $1.5 million. This particular borrower needs about $60,000 of working capital to start up the business and help with transition. We're going to include soft cost and fees to appraisals and environmentals. So we got a total loan amount of $1.65 million. In this situation, the borrower is going to bring 10%. okay? In some cases, that can go down to 5% if the seller's willing to hold, okay? So now we have a loan amount of 1.485 million. That's a monthly payment of about $9,100. And we're assuming a 5.5% rate over a 5-year fix with a 25-year term. You can see those assumptions on the left. A lot of assumptions here, but we're getting to the punchline next. How does this look? Well, it's going to come down to how well the cash flow can support that payment. So you can see in the example in the blue box, I've got the total EBITDA of 227,000. And as I told you early, that EBITDA is telling us how much cash flow the business has to support debt. 227,000. That was a negative 23,000 in net income plus all the add backs. Okay. If we would not have had the add back information, we wouldn't have got to the 227. All right. We're going to back out the new owner salary. We're going to assume that's 50,000 in this case. Okay. And then we're going to divide by the annual payments. 123,000 is the 9,100 a month times 12. That gives us what we call a debt service coverage of 1.4. That tells us that for every dollar of debt, you have 44 cents left over. The bank's goal is for you to have a 1.25 at least. So in this case, you've got 20 some more cent left over after every dollar of debt than we want you to have. It's good. That's good. So if you were looking to buy this business, because this business has done a pretty good job managing its expenses, you know, its EBITDA is pretty healthy, it can support the amount the business owner wants for it. And because of that, you're more than likely to get an approval as long as your credit's good and there's nothing too alarming. Okay. But again, as we talked about, if the accounting of this business would have been off, it would have been difficult to find those add backs. All we would have had to work with is negative 23,000 plus maybe a few dollars, and this wouldn't have worked. It was only because we kept track and had access to information that we were able to add and make that large of an adjustment. Bob, I'll stop there. Did you have anything you wanted to comment on?
Well, I think this is probably the most important slide of this whole presentation for the audience to understand is there is the number that the seller wants for their business, whether it's right or wrong, there's a number in their head. Then there's the number that the buyer is willing to pay for it. And most buyers are going to go to a bank, and this is what the bank's going to allow them to pay. Whether it's Live Oak or anybody else, they're only going to lend you so much money based off the cash flow of the business. So unfortunately, I have to talk to a lot of owners who have a number in mind and their business just doesn't justify the number they have in their mind. So we have to pull their expectations down to reality. And the bank's responsibility is to keep the buyer from overpaying for the business. So it's a joint effort on both parties to come to a kind of a middle ground where both the buyer wins and the seller wins in this transaction. And this is really kind of the bottom line where this debt service coverage ratio comes into play.
That's right. And you look at the left, the stats there, right? The SBA requires 1.15, Live Oak requires 1.25 on your coverage, and our portfolio average is 1.65. What that tells me is that we're putting people in healthy positions. And that's the goal. As a buyer, avoid being enamored by just getting the business and paying whatever's being asked. Focus on what it can afford, what you can afford, and you're going to have a healthy business. I will tell you firsthand, we work with Bob and his team a lot. Our goal was not to get the seller less than they want. That's not our goal. Our goal is to help both parties win. Our goal is to help our buyer get a healthy business and to afford a price that's going to help them have that business for a long time. And in doing so, I think both parties, the bank and the buyer, want to get the seller what they want. So it comes down to one, if you ever become a seller, it comes down to how well you've managed your financials and how organized you are. And it comes down to the buyer's ability to do the same. So both have a role in this. And as we finish up, we'll take a few seconds here to go over this. We just gave you an example of an SBA loan. On an SBA loan, if you're a first-time buyer, the seller can hold 5%, and you would have to bring 5% cash of the total project. So if you're buying a $1 million business, okay, then you would need at least 50,000, and the seller would have to hold 50,000, and the seller would have to hold that on full standby until you pay that loan off. Okay, otherwise you're going to need the full 10%, 100,000 in cash. That's SBA. Okay, if you're when I say a more mature borrower, if you have strong personal liquidity or you've owned your own business for some time, okay, then you might be more of a conventional borrower, which is the very right column, okay? We can lend now with our participation partnerships, we can lend well and above 50 million and get into credit lines to more mature buying groups if you're looking to grow aggressively, or we can fund that one-time transaction that's your average loan size of 2 million if it's right for you. But typically it requires a little more equity than the SBA. Okay, it's not quite as flexible, but just know that you know, between Live Oak and Johnson's relationship, you know, we can pretty much accomplish your goals by using any one of these products. You see the SBA 504, that's only real estate. It's rare that you only see real estate in a funeral home transaction, but the event you do, it's something to look at, and we'll look at that for you. But if any of these things cause questions or comments, I definitely think you should take a look. We did have 2 questions come in to Bob. I wanted to take a look at, and Bob, I'm going to ask you these questions and get your opinion. The first one was historically, what were the multiples of EBITDA and what are they currently?
Yeah, I'm looking at the questions too. They came in the exact same time, and they're pretty much the exact same question for Nathan and Jim who reached out. Appreciate the questions. Historically, and when we speak of multiples of EBITDA in the funeral profession, most of the transactions include the real estate. So our multiple includes the value of the real estate in there, and that's obviously off that cash flow, the EBITDA that's generated from that business. So sometimes the real estate value makes this a little tricky. But to answer your question, historically, the last few years, they've been, and keep in mind, there's smaller businesses, 1 rooftop locations in rural USA, and then there's other major city ones with multiple rooftops are going to grab a much larger multiple because of the pure demand for those businesses. But historically, I would quote 5 to 6 times. Here recently, they are probably 6 to 7 times is what we've seen over the last 12 to 24 months. And
yeah, and I would
sorry, Tim. I put that big asterisk on there is don't get hung up on that number right now. Let the market dictate what you need to pay or what you would get if you were selling. Trying to speak as we're talking to buyers. But don't get worried about that number at this point. It's what the business is actually going to value in the marketplace.
Yeah, to your point, Bob, you know, we've seen the same trend. If you'd asked me 2 years ago, maybe in a year and a half ago, the average would have been between 5 and 6 to 6.5. Now we're not seeing many that are below 6.5 to 7 times multiples in terms of the asking price. And we're seeing the asking price get up to 8 times, but we typically see the financing stay at around 7 at most. If your multiple of EBITDA on financing starts to go above 7, in most cases, 80% of the time, you're going to start to see a lot of cash flow stress. And for most of your independent type buyers, that's something that personally they shouldn't be stepping into. Bob, there was a question about cemeteries. I didn't know if you had any insight on that.
Yeah, Eric asked a question. What about current EBITDA for 200 plus call annual cemeteries internment? I think what he's probably referring to there. Those are very difficult. I probably can't answer that question right here on the spot, Eric. Depends really a lot in the cemetery world. Depends on the sales program that they have, which is really a lot of the value comes in the marketing and sales efforts of a typical cemetery. But happy to have a further conversation with you if you want to email me.
Well, great. Well, the day has been a lot of fun for me. I've learned a lot just listening to Bob's input. I really appreciate the opportunity to partner up, and I appreciate all of you that joined today. I would highly encourage you, if you have questions, no question is a dumb question, because that question and the answer to that could be the difference in you getting your next opportunity done or not. So ask the questions, contact me or Bob. Our contact information is on the screen. We absolutely appreciate your time. And Claire, I believe you are going to be providing maybe the slides as a PDF to the attendees afterwards, if they would like that.
Yes, for sure. I'm going to be sending out an email with all this information and Tim and Bob's contact information as well.
Great, Bob. Thank you. This was great.
Thank you, Tim. We appreciate all the attendees joining us this afternoon. It was hopefully beneficial to everyone. The market, the acquisition, the merger and acquisition transactions, it's one of those all-time highs right now. Obviously, a lot of owners are getting more and more tired. They're obviously getting older. And so there's lots of opportunities out there. I think it's wise to kind of look inside yourself and figure out if it's a growth and acquisition is something that's up here in the future for you. Be happy to visit offline on all those things as well. But
Great.
thanks again, Tim.
Thank you. We will see all of you again soon. Take care.